Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 as it continues its crazy market price action here. We believe that we are currently in a speculative bubble environment. We're seeing the S&P 500 real yields adjusted for inflation drop below zero for the first time since 2007. This does tend to be an early warning signal of a market top. We had one back in 1999 here before the dot-com crash. In the Nifty 50 bubble here, we had the S&P 500 earning yield drop into negative territory. And we have indicators like the equities as percentage of total assets go to all-time highs here, higher than the allocation we had in 1999 and higher than the allocation we had in the late 1960s after a 20-year bull run. Now, of course, these indicators are going off the charts because of the current monetary environment, because of the fiscal environment, because of low bond yields. That's not what the problem is. The problem is that equities are no longer being supported by the underlying fundamental values. And that creates an environment where you can potentially begin to see speculative bubbles form. And that's what we believe is happening right now. And we think it's about to get a whole lot crazier before we get a top. I think we're going to continue to see some crazy moves heading into the end of the year. And that's exactly what we cover on this channel. If you're interested in following that with us, make sure to smash that subscribe button. If you enjoyed these videos, smash the like button as well. It helps our channel out massively. Now, this video isn't going to be focused on the bubble or speculative type of environment. It's actually going to be focused on the fact that we haven't seen the top just yet and why most investors right now don't believe in this rally. Most people are skeptical of what's happening on the S&P 500 right now that's at all-time highs, and why that type of environment can lead to some crazy FOMO, crazy parabolic moves. And by the time that these investors flip to bullish, it's going to be too late. So now, without further ado, let's get right into it. Now, obviously, over the past few weeks, we've been grinding up here in this price channel. If we jump to a daily chart, you'll see the 50-day moving average has acted as a perfect line of support and also coincides with this level of support. We may get some volatility over the next 1 to 2 weeks that could provide some buying opportunities. Nothing major, but just potentially a short-term correction. Before we do that, let's take a look at this indicator that was posted by the SG Bank. I believe it's a French bank, and they have this indicator with quite a few variables that take into account investor positioning in equities, in bonds, and general sentiment. And this well-rounded sentiment indicator that they have is actually showing that investors are excessively cautious, that this is a -1 reading similar to what we saw in March 2020. Isn't that very weird, despite the markets being at all-time highs? And this goes back to what I was discussing in the beginning of this video, that from what we're seeing in the short-term sentiment indicators, a lot of investors are skeptical of what's happening on the S&P 500 right now. And as a contrarian indicator, that's actually the moment where I feel the safest in the market. But before we actually say that, we obviously need to dig a little bit deeper into it. Why are these investors cautious? And that's where they actually show us that investors are positioned to see rates fall, right? You can see what's been happening here. We've had this rise in the sentiment where investors are expecting rates to fall. And you go across social media, you go across YouTube, all you see are macro videos talking about rates that are about to fall. And that means that these investors are positioned in bonds and not equities. That's what this means here. If investors are positioned for rates to fall, then that means that they're expecting bonds to rise. Rates and bonds have an inverse relationship. They have a perfect inverse relationship. And so that's why this bank here is including that in their overall analysis of market sentiment. It's because if investors are positioned long on bonds, that tends to mean that they're not positioned in equities, and they actually expect equities to fall, right? Because when bonds rise, you tend to see stocks fall. That tends to be the relationship because investors need to either allocate to bonds or to stock. So you can see here throughout July 2020 all the way till March 2021, you had a huge drop in the price of bonds, and that was of course fueling a massive rally in the S&P 500. So these investors are positioned into the bond market, not the equity markets. And so that tells me that there's a lot of potential buying power for equities and not much potential buying power for bonds. So from a risk reward standpoint here, if everyone is already positioned into the bond market, then all they can do is sell. And what are they going to do when they sell their bonds? They're going to be buying equities. Now that's the concept of contrarian investing. If we take a look at the CNN Fear and Greed Index here over time, this again is a contrarian indicator, meaning that when there's a lot of fear in the markets, that's typically when you need to be buying. When there's a lot of greed, you need to be selling, right? And what's interesting is we've come off a 20% reading, right? And that's only happened a handful of times. It happened here in March 2020 when we crossed above the 20% reading. It happened right here in September 2019 and in January 2019. And why am I looking at that? Because it's very important to spot those moments where the markets go from bearish, expecting downside in equities, to expecting upside. Because that's the moment where you see this rush out of cash and bonds and into equities. And in all three of those cases, March 2020, of course, we saw a massive rally. September 2019, we saw a large rally from that moment on. And January 2019, right here, a massive rally. Now, seeing a similar type of development on the sentiment when the market is at all-time high is quite interesting, but I think that's just a symptom of just how much liquidity we've had in the system. And despite investors not being fully allocated, the markets have been able to rally significantly. So what's going to happen if bonds begin to fall and those investors that are holding bonds see a strong market like this and begin to capitulate out of bonds and into equities? What's going to happen? That's going to push the S&P 500 higher. It's going to create FOMO. It's going to create a large speculative move up and push equities into historical valuations and extend this trend way too far up as we head into a long-term top. I believe this bull market is going to be ending with a big bang, trapping a lot of people at the top. And the truth is right now, if the markets dropped, not many people would be trapped. Now, of course, this is going to lead to a very weird type of environment where we've got stocks that are massively overvalued and cash and bonds that are very, very likely to get devalued as we continue to see currency being printed and monetary debasement taking effect. Everything that's been working for around the past 40 years, ever since 1982, where we saw that big peak in bond yields, and we've been in that downtrend ever since in yields, that's been pushing the stock market higher over 40 years. Everything that's been working throughout that period is all of a sudden going to stop working. So all the classic stock and bond portfolio investing, passive investing, I believe that's all coming to an end because you're going to have the stock market being pushed into historical valuations, which significantly decreases your future expected returns. That's what's happening with the current rally that we're seeing. We're being pushed too high too quickly and borrowing from future returns, and you're eventually going to see the bond yield at 0%. And so that's going to give you very little potential interest on your bond yield and very little room for your bonds to appreciate in price. So the classic stock to bond portfolios that have been working since 1982 here, those are probably going to be dead for a significant period of time. Now, of course, we're in the last phase of that, right? We haven't seen the markets topped. We haven't seen bonds top just yet. I believe there's still a few trades to make, and that's what we're covering in these videos. But if you want to have the longer term view, if you want to have our investment outlook and how we're looking to take advantage of the big trends that we're going to see from here on, go and check out our website at gameoftrades.net. We have an investment tab where we discuss all of our long-term investment ideas, where we're looking to allocate capital long-term, whether that's from an innovation standpoint or from a long-term macroeconomic standpoint. By the way, this is all going to be updated and redesigned in the coming website update, where we're going to make an investing tab with all of our investment ideas organized separately. I think the current environment is extremely complex to fully understand, and one of our goals at Game of Trades is to teach you guys exactly what's happening. Not just to give you guys what we're doing and when we're entering and when we're exiting, but actually make you understand what's happening with the current market, what's happening with monetary policy, how it's going to affect asset prices, and how you can protect yourself from everything that's about to happen. I think we're far from having seen everything that's going to come into play. So make sure to click the link in the description if you want to get a free trial to try out our service. Now let's get into I think the most interesting part of our video, which is going to be discussing whether or not bonds are going to fall. Because referring back to what we've been talking about in this episode, if bonds fall and those investors that are allocated in bonds capitulate out of bonds, that's going to be extremely positive for equities. So let's figure out what's going to happen with the bond market. And the first thing I want to show you is something called the copper to gold ratio. So this is the chart of copper futures. I'm going to divide this chart by the chart of gold. And that's going to give me a nice ratio that seems to be relatively stable, going down a little bit over time. So why are we looking at this? Because copper is a symbol or an indicator of economic strength. It's an industrial metal. When you have a lot of industrial demand, a lot of economic growth, you tend to see a lot of demand for copper, and so the price of copper rises. Gold is not a very useful metal. Gold is more of a risk-off metal. You tend to see the demand for gold rise when there's a slow in economic growth, when investors are scared that there's going to be a lot of easy monetary policy, and so they allocate more money to gold. So that creates a nice relationship between copper and gold. Copper being the indicator of economic strength and gold being the indicator of economic weakness. In fact, if we put up the 10-year yield on this chart here, you'll see that yields follow the copper to gold ratio perfectly. Right? And that's not much of a surprise because of the nature of copper and gold, but this is quite a fascinating relationship we have here. The bottoms are timed perfectly, the tops are timed perfectly. And so why am I showing you this? Because yields trade inversely to bonds. So periods where you see yields fall, that means bonds are rising. Right? That's how the bond market works. If there's a lot of demand for bonds and bond prices rise, that's going to lower the percentage yield you have on your bond. And so you can see there are periods where you have a divergence between what's happening with yields and what's happening with the copper to gold ratio. Here in 2017 to 2018, you had yields rise as the copper to gold ratio was falling. Now that told you that one of them was wrong, right? Copper to gold was going down, telling you that industrial demand for copper was going down. Economic growth was not strong, and that investors were actually looking for safety in gold, bringing the copper to gold ratio lower. So eventually yields turned around and came back down to retest that copper to gold ratio. So that was a perfect moment to be buying bonds because it told you that yields had gone up too far. Now look at what's happening here in 2021. We've seen a similar type of move occur where we saw a rise in the copper to gold ratio, a rise in yields, but more recently we've had this type of divergence where we've had the copper to gold ratio actually stay quite high because copper has been doing well and gold not so much, but we've seen yields fall dramatically. So that's again telling us that there's excessive fear right now in the bond market, that too many investors are positioned for rising bond prices, but cross-market analysis is just not saying that that's going to be the case. Now, as I was making this video, I saw this post on Twitter. I actually retweeted it if you want to check it out, from Tom McClellan, that makes these nice models. And this is one of them, the copper to gold ratio times 1,000. And what he did here is that he multiplied the ratio by 1,000 for it to match yields. And so that gives him a perfect relationship between yields and the copper to gold ratio. And over the last 14 years of data, you can see that when yields are too high relative to the copper to gold ratio, they tend to come back down. When yields are too low relative to the copper to gold ratio, they tend to come back up. Same thing again, we discussed 2018, that divergence, they were too high, they came back down. And look at what's happening right now. Ever since the COVID-19 pandemic, we've had yields that have been trending at a discount. So bonds have been too high relative to what the copper to gold ratio is telling us they should be at. Now, of course, there's a lot more that goes into yield analysis and what drives yields short, intermediate, and longer term. We've discussed many of those other factors in previous videos and on our website at gameoftrades.net. But this is just one more clue that we're getting here that are telling us that we might get another rally in yields before we make that top. And if that happens, those bond holders that we've seen on those indicators are going to capitulate into equities and potentially create some FOMO. By the way, make sure to smash that like button as hard as you can if you enjoyed this video. Now, that's about all I wanted to say in this episode. I hope you guys enjoyed. Again, if you enjoyed, make sure to subscribe to the channel. Now, in the meantime, I wish you good luck on your trading and see you next time.